start the presentation. This is the R&D Tax Credit webinar. Okay, we're going to have a few housekeeping slides. We have muted the phone, so there isn't any feedback during Steve's presentation, but we will unmute the phones at the end of the presentation so we can have some Q&A. If you have a question, you can also type it into the text box here. You can see moderator. I put a message up there so you can listen by phone. If you have questions that are more detailed, that you want a more personalized response, you can also email those to me or call, and then Steve will send out a detailed message. If you want them to be confidential or private, please note that so that we don't share that. But if otherwise, we're going to send everyone who participates today a copy of all the questions. Okay, we are going to silence the phones because of the feedback. We don't want to have this feedback on the computers or by the telephone. And as I mentioned, you can chat. We will answer these questions first in the chat message box. Okay, so now I'd like to turn it over to Steve. Steve is an accountant and specializes in the R&D tax credit, and we're very happy to have him here today to educate us on how we can take advantage of this program.
Good morning, everybody. This is Steve Regal, and as Bronwen mentioned, I'm in a unique position because not only does my firm offer the services in the R&D tax credit, but I learned about it when I was CFO of a company that went through the study. So I've been at it from both sides, and it was quite a learning process, and I'd like to share that. What I'd like to cover today, and if you're looking at the table of contents, I basically want to cover, some high level, an understanding of what the R&D tax credit is, who qualifies for it. I'll talk a little bit about how it's calculated, mostly for you to understand several methods, not to get into the detail of it, but to understand different approaches that can be taken. I do have a sample illustrated there. I do want to talk about concern over the methodology when a study is approached, because over the years there have been numbers of changes in how the requirements are called for to qualify for the credit and to provide supporting documentation. And I'll talk about audit situations. I'll talk about how the IRS looks at this, how the Franchise Tax Board looks at it. And as Bronwen mentioned, we will address some questions where we can, time allowing, but we will take all questions and provide a general summary of all questions and answers back to everybody. What I'd like to say at this point is that the law changed in the early 2000s. Back in 1960, the R&D tax credit first was formed, and it was made available mostly for large corporations who were creating something new to the world that didn't exist. In the early 2000s, concern was raised over the jobs that we were losing overseas and the skilled labor that we were losing. And the need was created to say we need to provide some incentive to the smaller and mid-sized manufacturing tech firms to become more competitive. And they basically changed the definition of R&D to some degree to provide a wider credit calculation to a wider array of people in those industries so they could take advantage of an incentive and utilize money to stay in business and grow their company. Although it's been around for years under the new method, and many companies have taken advantage of it, there are still a great number of companies that either don't know about it in enough detail to know it's even there for them, or they know about it but don't think they really qualify, or they're, because of various war stories that they've heard about audits and other situations, they have chosen not to pursue it, and all that really is happening is they're leaving a significant amount of money on the table. So I want to cover a lot of this today to clear up a lot of the myths and misunderstandings related to the R&D tax credit. What is the credit? It's basically an incentive that was created to apply to mostly manufacturing and processing type companies, people that are engaged in developing new or vastly improved products or new or vastly improved production processes and technologies, and that's for U.S. companies. As I mentioned earlier, the rules changed in the early 2000s to provide that incentive. And while this is a federal credit, many states have also adopted an R&D tax credit as well. In most cases, states follow the definitions supplied by the IRS for determining what is qualified. They might vary to some degree in how they calculate the credit. A good example would be, there was a time when Utah was basically saying whatever the federal credit is, the state credit in Utah might be 1.5 times that. They were trying to provide a great incentive to bring people into in technology and manufacturing into the state. Louisiana has done the same thing. They've created a credit that they call refundable. And they said whether you're losing money or not, if you have a R&D tax credit, you'll get it refunded because we want people to come in. California's been the most aggressive in terms of the value of the credit. Some states it's very minimal, and some states don't have it. That's something that we'd have to look at state by state. But the credit is definitely a federal credit, and in some states you can take the advantage of both. In terms of industries that qualify, I've listed a good number of them. I mean, there's all kinds of manufacturers, metalworks, fabricators, robotics, plastics, furniture, jewelry, apparel, all of these kinds of manufacturers can take advantage of the credit. Also, it's a huge opportunity for software developers. Pharmaceutical companies, making drugs and lotions and so on. Food processing, where you're experimenting with recipes to come up with new foods. Work in the life sciences and energy work. A lot of this is all driven by really what is called the, I'm sorry, I got the screens wrong for a moment. Let's go back for, so pardon me for my mistake. Here we go. All of this is driven by what is very simply known as the 4-part test. And if you're not sure if you're doing work that qualifies, you just have to basically, at least initially, ask yourself this question. Am I creating some new or vastly improved product or process? Now, it doesn't matter if other people have made that product or have developed that process. Is it new to your company? And if it is new to your company, something you've never done before, and it's either brand new or vastly improved, and vastly improved means you're using new materials or capabilities and trying to get similar or better functionality, then that part answers properly part 1. Test 2 is technological in nature. You must involve some component of the hard sciences, chemistry, physics, engineering, software, etc. There must be an element of risk, financial risk, and general uncertainty of failure. Now, financial risk could mean 2 things. One, either you're undertaking something where you're trying to develop something new or vastly improving something, and you're investing all of your money and hoping to develop a product or a process that will work so that you could ultimately sell it. Even if it fails, it still counts as an R&D effort. Even if somebody is paying you, but paying you a fixed price and you have to deliver, then you still have risk, because it has to work, and if you take it beyond the cost of what you expected, the rest is on your shoulder, you are still carrying some form of financial risk. It's only when you are paid for time and materials, so no matter what it takes, you're paid for it, then there's no financial risk. Then that destroys the capability of qualifying as an R&D effort. But if there is financial risk and there's the potential risk of failure, even if you understand basically, I know how to do this, I think I know how to do this, I'm pretty sure I can make it work, but I really won't know for sure until I test it and have it and prove it that it can work out right, I have some risk of failure. And in order to prove that it either passes or fails, you must have the ability to test some form of experimentation to prove that you've either eliminated all risks and you're ready to go to market, or there was failure and you're going to try and rework it, or you've decided I can't go to market. But if you meet this 4-part test, then the project that you are engaged in is considered a qualified R&D project, with one caution here, and it's something that I'm going to talk about later, but in the beginning, when these laws came out, when the new laws were revised, the IRS also said there's an 80% rule. The project, 80% of the project must meet this test. So, if I've had for example, a software application that I developed brand new, but now I'm going back and I'm just adding a small piece of functionality, even though the functionality itself might meet the 4-part test, the functionality that I'm adding is taking up a small piece of the time that's involved in supporting this product and project, and it's not 80% of the effort, therefore it wouldn't meet the test. And that's important to remember for something I'm going to cover later. But for the most part, you start answering these 4-part tests correctly, you have an R&D qualified project. When we talk about how the credit is calculated, and this, I don't want to get too complicated here, but I basically want to say there are 2 ways of looking at the credit. Essentially, when the credit was first designed, it was designed with the ability to say, if you're looking at it starting today, you can go back to the past 3 open tax years and recapture credit that you should have taken and could have taken years ago. For federal purposes, I can go back 4 years for the state. So obviously the advantage and the incentive to take this credit is initially based on going back a number of years, capturing what you could have gotten, as well as for the current year and then going forward, because now you have a real substantial amount of potential money coming back to you. But the regular method calls for the establishment of a base percentage, because the credit is defined as what they call an incremental credit. That makes the assumption that somewhere when you started or shortly after you started, you were engaged in some R&D. And the credit was meant to be an incentive to people who are continuing to increase the amount of R&D they're engaged in. So if I'm going to use the regular method, which allows me to go back years and recapture this money, I have to establish what is my base percentage as a starting point. Now, that can get a little complicated if you were a 1980s company, because do you have some of the records for income and wages during that period of time to effectively go through some kind of a calculation? Many companies do not. If you're a 1990 company or more, you probably do. If you were 2005 and after company, you fit the startup definition, and there are different calculations that make it easier to work with. So essentially, part of the necessary review is do you have the documentation to support a base period calculation? Do you want to even go dig it up? And sometimes it's a matter of, what might the potential value be before you make that decision. But for some companies who say, I don't have that data, I don't have that information, I can't get it, there is what's called the simplified method, which allows you to just look over the past few years and determine some other form of calculation without dealing with this base percentage. But the simplified method is only good for the current year and going forward. And a good example of this would be if you were, let's say we're in 2010 right now, and let's say, well, I know it's almost September 15th, but let's say it was a month ago, and you wanted to take advantage of the calculation, and someone said, well, you're a 1980s company, do you have the data? And you said, I don't have it, I can't get it. I don't even want to try and dig it up. It's way too time consuming. You could do the simplified method and just do a return for 2010 and use that method going forward for all future years. Other companies who have said they could manage to get some of the base data might be looking at a bigger number. What I've done, and I only did it for exemplary purposes, is first, regardless of which approach you take, the three components that go into the credit are wages, supplies, and contractor expenses. Now, the wages are basically as follows. And this is not just meant for lab people and engineers, but anybody and everybody who has done some amount of work that is related to a qualified R&D project, to the extent that the percentage of their time that they spent on working on qualified projects, that is the percentage of their W-2 wage and bonus that you could take for that year. To the extent that you are, like in the testing area, if you're building prototypes or using up supplies and materials for testing purposes over and over and over again, all the expenses that you've incurred for the using up of supplies and materials count. The wage portions that you figure and the supplies that you figure count as 100% of what they've calculated. In some cases, you might be using contractors to help you on a qualified project. For example, there is sometimes, in my case, when I was with an automotive aftermarket manufacturer, we had to use outside agencies to test for certain emission controls that we were needing for the state. That was a contracting expense tied to an R&D effort. Any contractor expenses, whether they be individual contractors or agencies or patent attorneys, anything of that nature, you can take 65% of those expenses and calculate. Those calculations count regardless of which method you use or has to be used. But what I did here, I did give you an example of how to calculate the simplified method. And what I did was I showed a calculation. I first used the regular method and showed for 1 year. If there was a base period, I made certain assumptions of the base percentage, made certain assumptions of the revenue of the company, and we created the base increment, calculated the qualified expenses for wage, supplies, and contractors, and I showed you how the credit was calculated. The question you might have is the difference of what's gross credit and net credit. The gross credit is the actual initial credit calculation, but since on your initial tax return you took expenses, and you can't double dip on the expenses, I have to add this amount back into income and that adds a 35% back. But the credit is a dollar for dollar reduction off the bottom line. So it ends up being a 65% net benefit, but that's the resulting net credit, and that's how the government calculates it. So I showed that for the regular method, and then I showed how the simplified method is calculated. as an example. Now, the only difference, if I go back to the regular method, if I see that, and I'll use California as an example, if I'm looking at a $91,000 credit for federal purposes, in the state of California, I'm pretty much looking at anywhere from 85 to 95 for a state credit as well. So that could be a substantial credit for 1 year. And don't forget, on the regular method, I can go back 3 years. So if I'm able to go back, I'm looking at roughly this kind of credit 3 times or 4 times over. Whereas if I go to the simplified method, that's a credit for the current year only, and I could look at it going forward. So that's just something you have to take into account, and usually the service provider you're working with, and I'm going to discuss that in a little bit later, should be able to help you do some analytical work before you really get involved in an engagement. But here's what really is where I wanted to get to today, and this is the important part of what's happened. When the regulations were changed initially in the early 2000s, it went from being a very strict, very detailed accounting support requirement to almost a very lax method where people can say, here are my projects, here are my people, here's the money I want, give it to me. The IRS obviously was complaining for a while that it became too lax. Over time, over the last few years, there have been numbers of court cases. In most cases, the court situations ruled in favor of the taxpayers, which gave them an ability to even collect more money. But at the same time that happened, it also tightened up some of the requirements for how you can report people and expenses to a project, how you qualify a project, and how you basically document and support all that effort. And that has become, the methodology has changed somewhat, and it has become a critical part of recent calculations and an issue that has caused some audits to arise. The fact that audits have come to be does not mean this is a bad credit, does not mean it's a wrong credit, it does not mean that there is money out there that you should leave on the table. It just means you need to be sure it's being done right. And what you need to do is pay attention to some of the recent court cases, and the service provider you work with should be able to give you a comfort level on the fact that they're aware of the cases, they know how to use them, and they know how to help create the support that's needed in the allocations properly. I'm going to cover part of that right now. First of all, let's talk first about what will trigger an audit. If you're in a typical industry that usually qualifies for credit, that doesn't become an issue. The IRS obviously is going to look at, if you're a marketing company, what is a marketing company doing qualifying for an R&D credit? Because a lot of financial and marketing-oriented efforts are not considered technological in nature. Doesn't mean they haven't done something, but that might be one trigger. If you have an extremely high credit in relation to your revenues, they might look at that and say, why is it so high? Or if you're amending prior year's returns, you're going back 3-4 years, they're going to want to make sure that at least you've calculated that base period right and that you've done the allocations correctly. So those are areas that they will look at. Those are the biggest areas of concern. Now, nobody can guarantee you will or will not be audited. Don't ever let anyone tell you this is not going to be audited. You can never tell. First of all, forget the R&D for a moment. The IRS or the Franchise Tax Board has the ability to do random general audits where they can look at anything they want at any time. And if they do that, if you've taken an R&D claim, that will be pulled into the general audit review as well. Usually if they're looking at the R&D audit, they stay within the R&D focus, usually. But in most cases, both the IRS and the Franchise Tax Board have some restriction with resources and the ability. They can't audit everybody. So what they look for are triggers. What they look for are high-value claims that might be subject to some scrutiny that they want to put into. And they have what they call a superset of IDRs. It's an information request. Basically what that is, it basically is a document they can send to you saying it might just be a field audit. They might just be looking for information. But when you answer those questions, you basically have the answers that are given, basically provide them with the information they need to know as to whether you've done it right or not. So most service providers will include audit defense in the studies they do, and most of them should be reviewing and preparing the study they do in line with these set of super IDRs, because if those questions can be answered up front, then there's no problem with everybody having the comfort level going forward. But this is basically, the IRS has taken a look at companies who might be trying to establish a very low base and they don't have all the documentation, so they can't really support the base period, but they have a number. Some companies have been allocating people incorrectly, and those are the key areas that they look at. Let's talk about some of the court cases before I get into the screen on the IRS, particularly with their positions. Two court cases that have had a very significant impact on the R&D credit are as follows: TG, Missouri, and Trinity. Now, you remember I discussed earlier that 80% rule. A lot of software companies, in their initial development of a software application, are heavily involved in R&D. But obviously in the early years of their development, there's no revenue, so they have all these losses that they're carrying forward. And by the time they start to make some revenue, they have all those losses to write off. But by the time they get into a profit position, any new work they're doing on that application might not meet the 80% rule. So for a long time, software developers had an issue of not really being able to benefit from this R&D tax credit. In the case of Trinity versus the IRS, Trinity was a shipbuilder. And one year, when they did their return, when they initially went for the return, they had a tremendous claim that the IRS denied. They went all the way up to the top court. The IRS's argument was, you've been building ships every year, you know how to build ships, there's nothing really different about them, so you can't continue to say shipbuilding is technological in nature when a good portion of what you're doing is the same. Trinity argued that while the ship itself might be the same, there were components within the ship that were different, technological in nature, like the new radio and communication systems, computer systems they were putting in the boat. All these things that they were adding that required serious testing over and over again, high-risk effort. And the ultimate ruling was as follows. The courts ruled that while the IRS was correct in denying the overall claim because the basic shipbuilding knowledge was no longer technological in nature, they knew what they were doing, that companies would have the ability to take the components of the project that were technological in nature and treat them as a project by itself. So now, they didn't have to look at the whole ship as meeting the 80% rule. They could look at the individual technological piece they were adding and saying, that's a project by itself, and we don't have any problem anymore. And now instead of the ship being the project, they might have 3 subcomponent efforts that became 3 projects by themselves. That opened up the door to a lot of companies to continue to get a lot more credit back because they now could expand what is considered a qualified project and who's working on it. And all that would add up. The other court case that expanded the capabilities greatly was PG Missouri. You remember I mentioned earlier that we said all the supplies and material used in testing could be expensed for R&D purposes. But the initial basic rule was that those supplies and materials then had to be destroyed. If you kept them for resale, you weren't allowed to count them. Essentially, PG Missouri argued and said, well, we're building molds for clients. We think we know what we're doing, but we have to build it and test it, and we're using a lot of material, a lot of supplies. But once it's tested and meets the test, I have it ready for the client to sell. I've done all this R&D work, and now you're telling me I can't count it because if I destroy it, then I have nothing to sell to the client or to utilize for the client. So the courts changed the ruling on what counts for supplies and material expenses. And as long as you're using it in testing, you can expense it for R&D purposes. Now this opened up the door to a lot of jewelry companies who use a lot of gold and silver and other metals to build prototypes for their jewelry to see if it has the look and feel they want and if they can manufacture it. Well, then they may melt the gold and silver down and reuse it again. They can count that. So these rulings had a great positive approach on expanding what taxpayers can claim for the credit. But at the same time, the IRS said, while we wanted to make the bookkeeping part a little bit easier, because a lot of the small and mid-sized clients don't have the resources to have a real time and attendance project-oriented system that the Fortune 100 companies might have. We can't just allow people to just make up percentages. So there was a requirement to somehow show and allocate all the different people to the different projects on a task-oriented basis and a percentage basis to show how it adds up. So you might have 25 qualified projects. You might have someone working on all 25. You might have someone working on 1 or 2. There might be multiple tasks within a project. Someone might work on multiple tasks or just one. They want to see that. And they want to see what some of the non-qualified work, what do they do? That's just building a matrix. You don't necessarily have to have the perfect timekeeping system or reporting system. As long as you have some documentation, whether it be job descriptions, emails, drawings with names on it, test plans, test results, meeting notes, especially if you're ISO certified, where you keep meeting notes and people's names show up and where you can attach them to a project or to an effort. You have enough documentation to support the claim you're making. And we help a lot of companies, and a lot of the service providers should be able to help companies through that matrix approach. But that can greatly expand the amount of benefit that people can claim. One big mistake that has been made is that in lack of understanding, the IRS has a position that if you are working 80% or more on qualified research activities, then you can claim 100% of your W-2. And we've seen a lot of cases where companies have claimed 82%, 83%, 85%, and then just taken that percentage of the W-2, and they could have taken more. So again, there are some mistakes that are being made. There are some cases where people are not current on some of the regulations, and that only results in leaving money on the table. But getting to the position, the IRS, they tend to have a very knowledgeable staff of engineers and other personnel who really know how to evaluate the qualified regulations for the R&D project. If you make a claim, they will tend to pay right away. And the reason for that is, just like when you owe money, you owe interest. If you amend some claims and they owe you money back, they owe interest on it. So they will tend to pay first to avoid the interest accumulation. And if they want to or feel they need to, they'll audit you later. As I mentioned, they have the super information request, which is a way for them to look and see if there are any flags without committing any resources. But even across the country, some agents can differ in their own interpretation of the rulings. And that's why it's important for the service provider to stay current with the court cases and regulations so that they can defend these different interpretations properly. With the Franchise Tax Board, the state agencies, a lot of them don't, now I'm not going to say all of them, but most of them don't have the skilled resources the IRS has. A lot of them have been claiming they're broke because of other economic issues. They might use the audit more as a delaying tactic, hoping to settle and paying less on the dollar. Sometimes they will, as I said, they could pull it in because of a general random audit, but if it's an R&D audit strictly initiated by the state, it's more than likely a delaying tactic. Not always, but usually. But when they delay it, that's only increasing the amount of interest that they owe because they don't pay right away. Now, what's interesting to note and important to note is when you're engaging in a contract with a service provider, the federal position is contingency contracts are not allowed. And one of the first questions they ask in that information request is they want to see a copy of the contract. If they see a contingent contract, they could just deny the claim. It can result in penalties to the service provider and to the CPA as well. States, however, do allow contingency contracts, so it is not unheard of when companies are applying for the credit and going back multiple years to have separate engagements for the federal claim and the state claim. This way, at least if the state's going to delay and drag it out, your payment to the service provider is delayed and dragged out with it until such time that you get paid. So that covers the position on the agencies. To summarize this, and I know there'll be a lot of questions. You can't cover everything today in one simple session. But quite frankly, between the IRS and the Franchise Tax Board, over the past 7 to 8 years, billions of dollars have been paid out. Yet there are many firms, even today, that have hundreds of thousands of dollars per year that they're not going after, and they should. So any help that that can be given should be reviewed. What I've seen done, I know what we do, but what I've seen done by a lot of service providers is without a lot of effort up front, they could work with you and the CPA to determine if it looks like you are a company that does qualified work. If there was a credit, would you be able to utilize it? And do you have access to the documentation needed to go back, or should it just be for a simplified approach for the current year? All of that should be answered up front before you go into any kind of an engagement, or very minimal expense going to some engagement like that. This way, at least, then there is a solid feeling on your part and on the CPA's part that A, you deserve the money you're going to get, you're going to be able to utilize the credit when you get it, and if you were audited, there's a strong ability to know that this can be defended properly. So I'm ready for questions. Hopefully, time allowing, we'll be able to address the questions. And if not, as I said, we will be taking them all and providing an overall set of questions and answers back to everybody. Generally, for this last screen that I've shown you is just if you provided this following data, at least some average of an estimated credit could be provided back to you, and at least both federal and state if you're in a state that allows a state credit.
So we have a few questions in the chat. We're going to begin with the questions in the chat window, and then we will open the phone line. So first we have John. John says, can the science be statistics or advanced mathematics?
Yes. The answer is yes.
Okay. Then we have Chuck, who asks, how is this viewed if the company owner has conducted the R&D over the past several years? Is John on the line? Yeah. Okay, we're going to open up the phone lines. 1 second, please.
All attendees have been unmuted.
On the line?
Okay, I see Chuck is on the webinar. So Chuck, if you could elaborate on your question. Okay, and while we wait for Chuck, we'll go back to John. Follow up to Chuck's question: can the flow-through income be K1?
No,
K1 be included in the qualified wage calculation?
Yes. Yes, it can. But getting back to Chuck's question, my interpretation of that is, and I'll tell you, the company that I was with, the owner, in many cases with a small business, the owner is the driving force of the R&D. The question is not if the owner himself is doing it, it's what percentage of the owner's wage do you take and can you justify? Because the IRS's position initially is that the owner is running a business and is also involved in a lot of administrative, collections, AR, general production, hiring. So to attempt to take, like 80 and 90% of an owner's wage would be a little pushing the envelope, so to speak. But in many cases with small companies, the owners do the R&D, and that's not an issue. And I will tell you there was one case where I had the owner it was a one-man firm, was the owner. It was actually doing some military parts, but he was not funded by the military because that would have destroyed the R&D part. And he used a lot of contractors. And in his case, though, even though he was doing some administrative work, he was 99%, driving this R&D because that would have been the business. We took about 85 or 90% of his time, and it held up. But that's the rare case. In most cases, the IRS will not. I've never seen. If you go over 50, then you're pushing it. But I've seen generally people staying within the 30 to 50% range, depending on how much can be supported, is a reasonable amount to look at.
Okay, so Chuck has replied, the issue is W-2 forms, which is not the case if the owner is conducting the R&D. Does that make sense?
You mean the owner doesn't get it? I'm assuming you mean the owner doesn't get a W-2? I'm not sure. If the owner is not getting a W-2 because it's let's say like a single-owned company, a single ownership company, and he's just however he set it up, you're still going to have to look at a portion of what's his income in general, and take some percentage of it. There you're going to have to look at, if that's the case, then it still could work. It's just a question of we're going to have to say on the income, is the income coming from this entity? If there are incomes from some other entities, if he has multiple ownerships, we'll have to be careful about making sure we're just dealing with the profit that's coming from this particular entity that he's doing R&D from, and taking that. Now, if there's no profit, if there's losses, it's not worth going after, because you're only going to be getting a credit refunded based on the amount of tax you paid, or if it's in a current year, the credit can be used to reduce taxes. You don't lose the credit. If you don't use it in a particular year, you can carry it forward for up to 20 years. But what I tell people is, if you're in a loss position and you're not going to use this for 5 or 6 years from now, don't pay for something now. Wait till you get closer.
John asks, if the shareholder owner is an S corporation, gets $1 million of flow-through income from the entity, and the shareholder spends 80% of his time on R&D efforts, can this be sustained?
That's going to depend on documentation. Now, if we can establish through job description and a variety of emails, communications, meeting notes, some form of proof that he does literally spend that kind of time on it. And sometimes I've seen owners where the owner is the director of engineering, and in those cases, one of the partners who's so heavily involved, you can't sustain it, but you need to make sure you have the right documentation behind it. There are some case laws related to this, and I can get that for you.
Does anyone have any questions who are on the phone? Okay, well, thank you. Thank you to everyone for participating. We'd also like to thank the El Camino College Center for
I have one question. John, I guess I'm assuming that we have your email address here, so I will get case law and some documentation to support that and get that back to you.
And if anyone else has any questions, please send an email. You can reach me at bmadden@elcamino.edu, and we'll work with Steve to answer your questions. I'd like to thank El Camino College Center for International Trade Development and the Small Business Development Center, the District Export Council of Southern California, and TRC Advisors for helping sponsor this event today. Thank you very much.